from May to August, we're in the quiet phase. Everyone thinks it's all good, but I've calculated these quiet phases. They last about 3 months, maybe 4. So by that calculation, we should be, now that it's September, we should be at the end of the quiet period, getting ready for the second eruption of Krakatoa. So let's put a finer point on that. What are the 8 indicators that the banking crisis is not over and is getting ready to blow?
Jim Rickards underscores the deceptive calm from May to August, calculating that the current period, now September, might signify the end of this quiet phase and usher in a potential financial eruption. Rickards points out 8 indicators that collectively paint a worrisome picture for the banking sector. Firstly, traditionally upward-sloping yield curves are now trending down, indicating a pessimistic outlook as wholesale investors expect a recession or financial crisis. The Secure Overnight Financing Rate, SOFR futures curve, follows suit, reflecting a long-term bet on lower overnight rates and aligning with recession predictions. Rickards also notes negative swap spreads, where fixed rates in bank-to-bank or bank-to-hedge fund swaps are lower than those of the 10-year Treasury note. This departure from the norm suggests increased credit risk, as investors seem willing to accept lower fixed rates without government guarantees. Overall, Rickards suggests that these indicators collectively signal an impending crisis in the banking sector, with investors preparing for economic downturns and anticipating lower interest rates. Let's dive into the rest of the video to hear his thesis. Also, make sure to hit the like button, subscribe, and drop your comments below.
And I'll go through this quickly. Downward sloping yield curves. Now that, yield curve is just the x-axis are the maturities, the y-axis is the interest rates. Yield curves are supposed to be upward sloping. The longer the maturity, the more interest you're supposed to get. If I'm lending to you for 1 month, I want a certain rate. If I'm lending to you for 10 years, I want a higher rate because I'm taking more risk, more bad things can happen. Well, the yield curves are actually going down. What does that mean? It means that the big money, the wholesale money, expects a recession, maybe a financial crisis, and they think interest rates are going to drop like a rock. So why would I take less on my 10-year note than on my 1-month Treasury bill? Well, the answer is I think that 4% on the 10-year Treasury note is going to look pretty sweet when rates hit 2%. So that's what the market is betting. Number 2 is kind of the same thing. There's a downward slope in the SOFR futures curve, SOFR system overnight financing rate, secured overnight financing rate. It's basically what the euro dollar used to be on the CME, but they got the SOFR thing. But they're downward sloping. Now they're the same message. It's a little different contract. These are futures contracts, so you can go out 1 year, 2 years, 3 years. But whereas the Treasury curve is a spot bet on a long-term rate, the SOFR curve is a long-term bet on a spot rate. Now, as you're betting on what you think overnight rates are going to be a year from now. Again, downward sloping, which means the big money says rates are going to be lower. Well, why would they be lower unless you're going to be in a recession? Third one are negative swap spreads. A swap is basically 2 banks or 2 hedge fund and a bank, 2 counterparties basically say, I'll pay you fixed and I'll take floating from you. And you pay me floating, and I'll receive and I'll pay you fixed. So you're basically swapping interest rate. Now it's the same thing as owning a bond. If I buy a 10-year note in the market, I'm a dealer. How do I finance it? I finance it in the repo market. I finance it in the overnight. So I'm receiving a fixed rate on a 10-year note, and I'm paying an overnight rate in the repo market. Okay, receiving fixed, paying floating. So all a swap does is like, hey, let's do the same thing, but forget the bond. Like, why do we need the bond? Let's just pay fixed and receive floating, or vice versa, and we'll synthesize the bond holding with one important distinction, which is if I actually own a Treasury note and I'm financing it in the overnight market, I'm getting a rate on a government guaranteed security. If I do a swap with you and I'm receiving fixed, you're not government guaranteed. You might be a really good bank, high quality bank. So in theory, I should want a little higher fixed rate from you than I can get from the Treasury to compensate me for the credit risk. That's not happening. The fixed leg of the swap, which is bank to bank or bank to hedge fund, that rate is actually lower than the 10-year Treasury note. Well,
Right.
why would I take a lower rate from a bank or hedge fund than I can get from the Treasury?
In this next segment, Jim Rickards provides a compelling narrative on the potential triggers for the next recession. He emphasizes that the current financial landscape is marked by a balance sheet issue rather than a credit problem, indicating that banks are constraining their balance sheets. Rickards points to a credit contraction, a shortage of dollars, and collateral scarcity as concerning factors. He highlights anomalies in Treasury bill yields and reveals that rates at auction are lower than what the Federal Reserve offers for a phone call, indicating desperation to secure collateral. Furthermore, Rickards connects these financial intricacies to a broader global liquidity crisis, emphasizing the strong dollar's paradoxical rise amidst concerns about the U.S. going bankrupt. The looming recession is underlined by factors such as declining world trade, diminishing industrial output, rising inventory-to-sales ratios, and escalating losses in commercial real estate. Overall, Rickards paints a comprehensive picture, suggesting that the banking crisis is far from over and signaling a potential convergence of economic and financial challenges leading to the next recession.
It's not a credit issue. Nobody thinks that credit is better than the Treasury. It's a balance sheet issue. If I do a swap, it's off balance sheet. If I do a Treasury, it's on balance sheet. What does that tell you? It tells you the balance sheets are constrained. It tells you the banks are shrinking the balance sheet. It tells you there's a credit contraction. It tells you that there's a shortage of dollars. There's a shortage of collateral. None of these things are good. Treasury bill auction yields are from the Fed are lower than the Fed will give you for a phone call. So the Fed has a reverse repo facility. If you're a dealer, all you have to do is call up and say, I'll give you cash, send me some Treasury bills, and pay me interest on the cash, and I'll keep the interest on the Treasury bills. And they will for a phone call. Well, but I can also go into the market at auction for the Treasury and buy Treasury bills at auction. So, but those Treasury bill rates at auction are lower than what the Fed will give me for a phone call. So why would I fight competitively to get a rate that's actually lower than what I can get for a phone call? The answer is the Treasury bill you get from the Fed cannot be rehypothecated. I have to hold it on my balance sheet. I can't lend it to somebody else. Whereas if I own a bill outright, I can give it to UBS and they can give it to JP Morgan, they can give it to Deutsche Bank. The rehypothecation is the whole chain of leverage in the entire banking system. This is behind the curtain of the Eurodollar market. So the point being, if I'm willing to take a lower rate on a bill that I can pledge than I can get for a phone call, it tells you that there's a collateral shortage. It tells you that I'm desperate to get my hands on that Treasury bill that I can pledge because there's not enough collateral to go around. The strong dollar, everyone's like, the BRICS are taking over, the dollar is falling apart, debt to GDP ratio is 130%, the US is going broke, forget the dollar. Really? Well, why is the yen crashing? Why is the euro crashing? Why is sterling crashing? Why is the yuan? They're fighting desperately to keep it above 780. Why is the dollar getting stronger against every major currency in the world if the dollar is the currency of a country that's going bankrupt? The answer is there's a dollar shortage that, believe it or not, for all the money the Fed printed, the amount of leverage in the system is 100 times that. So, so it goes back to collateral shortage, bill shortage, dollar shortage, shrinking balance sheets, liquidity. There's a whole global liquidity financial crisis coming. At the same time, there's this whole recession coming. And we haven't talked about the recession, but those are the rest of my issues. Declining macros and world trade shrinking. That hasn't happened since the Great Depression. Industrial outputs declining, rising inventory to sales ratios. That means the warehouses are full. They can't sell the stuff. And then finally, icing on the cake, massively increasing losses in commercial real estate. So these are all hard data points that speak recession and global financial crisis and tell me that this banking crisis is not over.
As we wrap up this analysis, Jim Rickards provides a sobering perspective on the potential triggers for the next recession. The intricate dance of balance sheets, a credit contraction, and a shortage of dollars reveal a complex financial landscape. Rickards highlights anomalies in Treasury bill yields, underscoring a desperation for collateral and signaling a broader global liquidity crisis. The paradoxical rise of the strong dollar amid concerns about the U.S. going bankrupt adds another layer to the impending challenges. With declining world trade, diminishing industrial output, and escalating losses in commercial real estate, Rickards paints a comprehensive picture. It's clear that the banking crisis is far from over, and the convergence of economic and financial challenges may well be the catalyst for the next recession. Stay informed, stay vigilant, and subscribe for more insights into the intricate world of finance.